Welcome back. Let's get a broader look at the markets and a look at the U.S. election, which is now just days away. It happens on Tuesday with our expert guest. He's Tony Ciero, Senior Portfolio Manager and VP at Caldwell Securities. During the break off camera, you said that you're in the camp that believes markets are strongly pricing in a Donald Trump victory, correct?
Yes, if we look at it, it's about a 2/3, 1/3 Donald Trump wins. And that generally means it's good for the energy industry in the U.S. as you'll open up contracts for new exploration and shipping. Also might be good for big banks in the U.S. because you may relax some of the Basel III requirements tied to Tier 1, shoring up Tier 1 capital. If that happens, you look at Bitcoin as well, throwing that out there, hitting new highs because expecting Trump to win. If we do see a Harris win, then the markets could be flipped, so we have to be careful about there. But right now, it's a very tight race. It's 50-50. So one thing I know is whoever wins, half of the population in the U.S. will be upset. Yeah,
and I assume you advise investors and clients not to make significant position changes based on the outcome of any election. Is that correct?
Yeah, exactly. Again, it's calculated risk we take for our clients' portfolios, very well diversified. If a client's looking for investment opportunities, then right now, yes, we do favor U.S. equities and the U.S. dollar. And I mentioned a couple of stocks before. In Canada, though, where growth is a little bit subsided, we recommend more dividend-paying stocks, especially in a declining interest rate environment, where it could give a little prop into the prices of these dividend-yielding companies.
Yeah, you favor U.S. equities and the U.S. dollar right now.
Yeah.
Why so?
Again, if you just look at the growth of the U.S. economy relative to Canada, it's a lot more stronger. GDP numbers in the U.S. came a little bit lower than expected, but it's still about 2.5 times the amount of Canadian growth. Long term, we think they'll normalize in around the 3.5%, where Canada will be a little bit stagnant, about 1.5%, unless we change a few policies here.
You favor Canadian dividend payers, and would I be correct in this, believing that is largely because of the preferential tax treatment that Canadian dividends receive?
That's always a benefit, absolutely, for that. But in a declining interest rate environment, generally speaking, these higher yield companies do well. They're boring. Costs come lower, so it means more profit to them. When interest rates rose a couple of years ago, you saw the Bell Canadas, the Enbridge really take a hit, and not necessarily to do with their, well, some issues with their corporations, but it's more because of the interest rate sensitivity to these companies. But right now, two companies that we do like is Royal Bank, and I've been on the episode before talking about Royal Bank. It provides a stable dividend of about 3%. It grows its dividend out roughly about 3-4% per year. Over the last 5 years, I think it's grown its dividend by 40%. So if you just held it over the last 5 years, your dividend growth is up 40%, which is...
It's had a great year, and you think that, we're going to talk about this stock in just a moment. Royal has had a great year. It's the most influential mover this year on the TSX, has contributed the most, more than any other stock, to the big gain on the TSX. You think that story is not over?
Not at all. The growth is forefront at the Royal Bank, and couple in with some issues with the other Big Four banks, and you can see a clear winner, and it's been awarded there. So recall earlier this year, it merged with HSBC Bank Canada, took on the assets, and we've seen that filter to the bottom line last quarter, and we see similar results when they post their fourth quarter earnings next month.
Okay, let's talk about BMO, because there have been concerns about BMO, and that is its U.S. Lending book. Some time ago, not that long ago, an analyst who actually works for RBC Capital Markets issued a report that got a lot of attention, and he flagged business loan losses at an elevated level at BMO, significantly more so than other lenders in the same space.
Yes.
Your thoughts?
Exactly. So BMO, the share prices have been depressed because of that. I think it's roughly flat for the year. And loan loss provisions, last quarter earnings, it was higher than investors expected, and BMO took a hit because of it. Let's start with the dividend yield there. It's closer to 5% because the price hasn't appreciated, but its dividend yield has. So you get that nice cushion of a 5% dividend yield. But interest rates in Canada have dropped about 1.25% since June or so. So Bank Canada has cut rates quite a bit. Eventually, you want to see that filter down to the consumer, and could potentially mean BMO keeps more of their earnings if they have to put less aside to loan loss provisions. So you can see a little bit of a boost there if numbers start to switch on loan loss provisions, and they start making more money for their investors.
Okay, and another stock you like, Berkshire Hathaway, the fabled vehicle of Warren Buffett and company.
The reason why we like it, it gives you private equity exposure in a public setting. So it's daily traded, and we're talking about the B shares here, which range about $460 US. The A shares are about 700,000 US, so stay away from those, unless you have the money, of course. But the reason why we like it because of the private equity capabilities. And a couple of names, Geico Insurance is one of the holdings there. Dairy Queen, they've held that for a very long time. So those are private companies that you can get exposure to. So we prefer in our asset allocation model companies that have an allocation of private equity, and Berkshire Hathaway fulfills that need.
Tony, thank you a great deal for a good conversation.
Thank you.
Good couple of conversations.